Hello students, welcome to all of you Shiksha 360 CAP classes. In this session, basically we have to cover the BFM chapter number 8 part 2. Very important chapter this session, whatever basically we will discuss. This is a short session and I will try to you understand some of the basic points regarding that. Clear? First of all, we will discuss a case and after that we will move towards the theory. So without wasting much time, let's start our discussion. Chapter 8 ABFM Financial Ratios Part 4. So under that, first of all, there is one word comes that is leverage. As in the previous session, we have also discussed. So can anyone define what is leverage? Leverage basically it is due to the fixed expenses. Clear? So leverage basically it is due to the fixed expenses. So basically due to the leverage, there is a reduction in the profit. Clear? So leverage basically why this happens? Leverage basically we can say that other some extra expenses. Clear? Other some extra expenses, and this is led due to the fixed expenses. Clear? And if we are doing some other expenses, clear, if there is some other expenses to be going on, then what it impacts? Clear? Expenses that is basically means that it leads to the reduction in the profit. Clear? So what it leads to that? It leads to the reduction in the profit. Clear? So this is the basic understanding of the leverage. So now let's discuss. I hope all of you are remember what is EBIT. Please tell fast in the comment section. What is EBIT? What is PBT? What is PAT? What is contribution? Okay, EBIT, that is earning before interest and tax. Profit before tax. This is profit after tax. Clear? So these are some of the terminologies. Clear? So on these terminologies, we have to discuss one numerical also. Clear? On the basis of these terminologies, we have to discuss one numerical also. Clear? So first of all, here we will take one example, that is assuming that is our sales, it is of rupees 10,000. Clear? Assuming our sale, it is of rupees 10,000. Clear? Kindly try to understand this example. Okay. So here in the sales, if there is a cost, we already know that basically cost, either it is to be fixed cost or it is to be variable cost. Clear? Variable cost is going to be changed with respect to the sales. Clear? As basically if we are increasing the sales, so our variable cost, it is going to be continuously increased. And if we are decreasing the sales, so basically our fixed cost, basically our variable cost, it is going to be decreased. Clear? Fixed cost here, it is to be remain same. Clear? So here, what we have to less that is variable cost. Clear? So here basically we have to less that is that is variable cost. So what is variable cost? We can say that just we are assuming here that it is to be 6,000 here. So sales, this is variable cost. Clear? So what we have left, that is contribution. Clear? So what is the formula of the contribution? Contribution basically it is equal to the sales minus variable cost. Students who are not able to understand what is the meaning of contribution, I will share you the marginal costing topic. Clear? Marginal costing topic of ABM. Sorry, of JIB. Clear? JIB accounting. We have covered the marginal costing topic. I will share basically with all of you. Kindly go through that. Clear? So that you are easily understand all these points. Clear? So up to this one point, that is if the sales it is to be of 10,000, variable cost here it is to be 6,000. Clear? So what is the contribution? Contribution, that is sales minus variable cost, that it is to be 4,000 here. Clear? Sales minus variable cost, that is comes out to basically in our hand, that is the contribution. So contribution here comes out to be 4,000 here. And after that, there are contribution. Clear? Contribution it is to 4,000. And in that contribution, there is some fixed cost also. Clear? That there is some fixed cost also. So basically we have to subtract that fixed cost. So in among that, what is the fixed cost here? That is rupees 2000. Clear? So in that, basically, what is the value of the fixed cost? That is rupees 2000. Clear? Out of 4000. If 2000 it is the fixed cost. Clear? So what amount we have left in our hands? Please tell fast here. I request to all of you, kindly please respond. So if out of the total sale, it is to be 10,000. Variable cost, it is to be, that is spending on the material or all other thing, that is, it is to be rupees 6,000. So what is the contribution? That is 4,000, 10,000 minus 6,000. That is to be the contribution here. Further in the next point, what they are trying to say here, that out of the contribution, there will be fixed cost. Fixed cost, that is rupees 2,000. Clear? So what amount basically we have left in our hands? Please tell fast what amount basically we have left. That is basically earning. That is the earning. Till now, basically, we have not paying any interest, not paying any tax. Clear? That is earning. EBIT. Earning before interest and tax. That is how much amount? 4,000 minus 2,000. That is to be 2,000 here. Clear? That is to be 2,000 here. Clear? 4,000 minus 2,000. That is to be 2,000 here. Among that, basically, if we are paying the interest, clear? Among that, basically, when we are paying the interest, after that, basically, we are paying the interest here. So basically, we have to less the interest here. Interest, it is to be rupees 1,000. So what we have left, that is profit in our hands. We have left profit, that is before tax. PBT. Clear? That is profit before tax. So what is the profit before tax? 2,000 minus 1,000. That is to be 10,000. Sorry, that is to be 1,000. After that, we are paying the tax here. Clear? So basically, we have to less tax here also. Tax, basically, we can say that 40% is the tax here. So 400, basically, we have left taxes. So what is PAT? That is profit after tax. 1,000 minus 400, that is 600. Clear? 600, it is to the profit after tax. Clear? 600 is to be the profit after tax here. So please tell fast now up to this much point. If anyone has any doubt or query, that is what we have sale, it is to be of 10,000. Out of that, there is variable cost, it is of rupees 6,000. So basically, we have what left in our hand, that is rupees 4,000. Clear? 10,000 minus 6,000, basically we have left 4,000 in our hands here. After that, we are moving towards that. There are also fixed costs. Clear? There are also fixed costs basically going to be occurring here. Clear? There are also fixed costs basically going to be occurring here. That is rupees 2,000. Clear? So contribution minus fixed cost, that is basically EBIT, that is earning before interest and tax. Clear? That is basically earning before interest and tax. That it is to be rupees 2,000 here. Clear? That it is to be rupees 2,000 here. Clear? Out of that, we have to pay some interest also. Clear? We have to pay some interest also. That is, we can say that like 50% of that. So 1,000 rupees interest. So we have to subtract interest out from that also here. Then after that, what we have left in our hand, that is profit before the tax. Clear? Because till now we have not paying any tax. Clear? Because till now we have not paying any tax here. So what we have left in our hand, that is profit before tax. This one. And after that, we have to pay tax also, that is 40% tax here. So tax, how much amount? 40% of 1,000, that is 400. So what we have left, that is profit after tax, that is 600. Clear? That is 600. Clear? So this is one scenario. On the basis of that, we have to also try to calculate what is the operating leverage, what is the financial leverage. Clear? All these things we have to be also understand from there. Before moving further, one thing I will discuss with you, that is what are the fixed expenses to be here. Clear? That is which they have to pay. That is first one, that is this one, it is the fixed one. Interest, it is to be the fixed one here. Clear? Interest, it is to the fixed one here. Or tax here, it is to a fixed one. Clear? This much they have to be pay here. Clear? This much they have to be pay here. Rest all these things basically will changes, but this much it is to the fixed here. Clear? That this much portion they have to pay here. So first thing basically which we have to calculate here, that is regarding the operating leverage. Clear? That is regarding the operating leverage. Operating leverage. So what is operating leverage basically with respect to this fixed cost? Clear? We have to calculate operating leverage. What is that? Operating leverage, basically take numerator and denominator of the fixed cost, that is. We will also understand that is contribution upon EBIT. Clear? Contribution upon EBIT, that is to be known as the operating leverage. Clear? That is to be known as the operating leverage. So what is that? Contribution here 4,000, EBIT that is 2,000. So it comes out to be 2:1. Clear? So operating leverage here basically comes out to be 2:1. What is that? Basically that is contribution upon EBIT. Clear? Operating leverage here, what is that? Basically contribution upon EBIT, that is just we are putting the values here. Clear? After that, what we have to do here, just we are substituting the values here, and on the basis of that we are able to calculate the answer. Clear? We are able to calculate the answer, that is contribution upon EBIT, that is to be known as the operating leverage. Clear? That is to be known as the operating leverage here. Next one which we have to calculate here, that is the financial leverage. Clear? That is to be the financial leverage. So financial leverage, basically how we have to calculate, that is with respect to the interest, that is with respect to this much point, that is EBIT. Clear? That is basically financial leverage basically with the EBIT upon PBT. Clear? EBIT upon PBT. Clear? EBIT upon PBT. 2,000 upon 1,000. That comes out to be 2 here. Clear? That comes out to be 2 here. Clear? So here financial leverage, what is the financial leverage here? Basically that is 2 times. Operating leverage also basically that is 2 times. Okay. So on the basis of that, these are the same things they are telling here, but I will directly move towards the question and I help you to understand that just whatever I have discussed here. Clear? Basically with the help of this one, we are able to solve the numerical. Okay, so now let's move towards the numerical here. So here they are giving one question here. Let's try to understand basically what they want to say here. And here what we have to calculate. Clear? And here basically what we have to calculate, that is operating leverage. Clear? So what is operating leverage? Sorry. Calculates it's a degree of financial leverage. Clear? So what is financial leverage? Financial leverage basically I have already tell you, EBIT upon PBT, or we can say that PBT, or we can say that like EBT, earning before tax, earning before interest and tax upon earning before tax. Here we have changed, that is profit before tax. Clear? Earning before tax or profit before tax, they have to be same meaning here. Okay, our main motive is that is we have to be calculate the answer. Clear? That is we have to calculate the answer with the help of the concept what we have discussed here. Clear? So please try to solve that here. So what is the sales of the company at the rate of 100 per unit? Clear? So sales here, that is of rupees 24 lakh. Clear? So if we know that sales it is of rupees 24 lakh, variable cost here, that is 50%. 50% of 24 lakh. Please tell fast in the comment section. Please tell fast here. If the sales it is to be of rupees 24 lakh and variable cost it is to be 50%. Clear? So variable amount, that is 12 lakh. So variable cost it is to be rupees 12 lakh. So what will be the contribution here? What will be the contribution here? Tell fast now. Please tell fast. 24 lakh minus 12 lakh. So rupees 12 lakh, it will be the contribution here. So out of that, what is the amount of the fixed cost? So basically fixed cost it is to be rupees 10 lakh. 1, 2, 3, 4, 5, 6. After the fixed cost, if we less the fixed cost to be here, so what we will get here, that is earning before interest and tax. Clear? Earning before interest and tax. If we subtract the contribution basically from the fixed cost, that is 12 lakh minus 10 lakh, what we will left here, rupees 2 lakh here. Clear? What we will left here, that is rupees 2 lakh here. Here it has shown that it has borrowed rupees 10 lakh at the rate of 10% per annum, and its equity share capital basically it is rupees 10 lakh at rupees 100 each. Clear? At rupees 100 each here. So equity share capital, that is 10 lakh, and price of each share, that is 100. So number of shares to be here, 10 lakh upon 100. It is to be 10,000 here. Clear? It is to be 10,000 here. That is the number of equity shares. Clear? Number of equity shares, it is to be 10,000 here. So if 2 lakh earning before interest and tax, and how much tax they have to pay here? Sorry, how much interest? Clear? First of all, here we have to calculate how much interest they have to be pay here. So that is borrowed rupees 10 lakh at the rate of 10% per annum. So interest here it is to be interest, that is 10% of 10 lakh, 10% of 10 lakh. So what is the amount of interest? That it is to be rupees 1 lakh. So here interest less, we have to interest here. Less interest, that is to be rupees 1 lakh. If we are subtracting the interest here, what we will left, that is earning before tax. That is to be 2 lakh minus 1 lakh, rupees 1 lakh. Now next step, what we have to do, basically we have to pay the tax also, that is 50%. So we have to less tax also. 50%, 50% of 1 lakh, that is rupees 50,000. So in the end, what we will left, that is earning after tax, rupees 50,000. 1 lakh minus 50,000, it is to be 50,000 here. Clear? So 1 lakh minus 50,000, it is to be 50,000 here. Okay. So please tell fast now, whatever I have started in the starting, in the first example, what I have discussed, just on the basis of that, we are able to solve this question. And here they are asking to calculate, that is calculate the financial average. Clear? Calculate the financial average. So how we can calculate the financial average? We know that that is to be EBIT upon EBT. Financial average basically with respect to that, this was interest. Take this component and divided by this component. Clear? EBIT upon EBT. EBIT here, that is what is the value of EBIT? That is 2 lakh. Upon EBT, that is 1 lakh. So financial leverage basically it is to be 2 times here. Clear? Financial leverage here it is to be 2 times here. So please ask fast. If anyone has any doubt, any query regarding that, whatever we have discussed in this example, please respond fast. We have discussed the 2 formulas. Operating leverage. What is operating leverage? That is with respect to that, contribution upon EBIT. Financial leverage, that is EBIT upon EBT. Just you have to be remember whatever I have discussed in the first example. On the basis of that, whatever they will give in the question, you just have to try to solve that. Clear? You just have to go with that flow, and definitely you are moving towards your answer. Clear? Definitely you are moving towards your answers. Can I explain this example once again, or you are able to understand the concept here? Please respond fast, all of you, because in the examination they will ask these types of question directly. Very less chances that they will ask theoretical based question from these topics. Very easy topic. Just you have to understand the concept here. Okay. So now further. So this is the thing that is sales they have given here. Variable cost, clear. So this is the solution of that, which we have not to understand because we are already understand the concept behind that. So now let's discuss what they are trying to say here in the theory portion. So what is financial leverage? Financial leverage, wait a minute, this one. Financial leverage, basically it is a double-edged sword. It may enhance the return on equity and beyond a point affect it adversely too. Clear? It may enhance equity, return on equity, that is, it may also give you more benefit, and beyond a certain point, clear, and beyond a specific point, it affect it adversely too. The fundamental rule of moderate, optimal, and overuse will apply here. In a smaller scenario, we can say that a business can afford to go for use above optimal level since the risk or the loss, if any, being small, can be controlled easily. And optimal level, basically, what is that? That is which is just the right mix of both the equity and the debt. Clear? So optimal level, basically, what is that? Optimal level, basically, it is one which is just the right mix of both the equity and the debt. How one arrives at the right, basically, it is a matter of fact and a realistic estimate of the cost versus benefit after the exercise of fund infusion is efficiently completed. Now let's understand further. This is nothing, no need to worry regarding that. So for calculating, clear? For calculating the degree of financial leverage, clear, whatever is important, now try to understand here. So for calculating the degree of financial leverage, we seek to establish the correlation basically between the operating profit, that is this one, and the interest expenses, which is assumed to be a fixed expense. Clear? Because interest basically we have to pay. Clear? Interest basically we have to pay, and it is considered in the form of the fixed expense here. Clear? Whatever I have write, or basically in the like operating leverage, that is what is that? Contribution upon EBIT, and between that, in the example, there is what? That is fixed expense. That is to be one of the expense here, that is fixed expense. Clear? As it is named. Otherwise, like next one, that is the interest. Interest, it is also considered one of the fixed expense. Similarly, in the case of the financial leverage, basically what we will take, that is tax. It is also one of the fixed expense here. Okay. So for calculating the degree of financial leverage, we seek to establish the correlation between the operating profit and the interest expense, which is assumed to be the fixed expense. Clear? Basically, which is assumed to be the fixed expense. If interest expense, basically it is quite large in a relation to the operating profit. Clear? That is interest expenses. That is, we are paying a large amount of interest. Clear? If the interest expense, basically it is going to be quite large in a relation to the operating profit, a small decrease in the level of operations. Clear? If the interest expense, basically it is quite large in a relation to the operating profit, a small decrease, clear, that there is a small decrease in the level of operations, and consequently fall in the EBIT will result in the disproportionate decrease in the EBT. Clear? Basically will result in the disproportionate decrease in the EBT. Clear? We will discuss this scenario, basically what they will try to say with that same example which we have discussed in the starting. Clear? Just wait few minutes, I will discuss that. Clear? Basically what will happen if we are increasing the sale, then what will happen basically if we are going to decrease the sales. Clear? So here there we can say that basically if we are paying the interest more, clear, if we are paying the interest more, so it will impact our profit. Clear? So that is, it will directly impact our profit, and we can say that basically it leads to the decrease in our profit. Clear? It leads to the decrease in our profit here. Okay. So how here we should have no doubt that earning before tax, it is directly proportional to the EPS. EPS, can anyone tell basically what is EPS? That is earning per share. EPS, basically that is earning per share. Clear? So here we should have no doubt that EBT, earning before tax, it is directly proportional to earning per share. as the tax rate and the number of equity shares are to be constant. Clear? Because number of the shares are to be constant here or just to fix here, and the tax rate basically it is also to be fixed here. Okay. So that is what is earning before tax. Basically, it is directly proportional to the earning per share. So therefore, any percentage change in the EBT, very, very important. Clear? So any percentage, basically, if there is any percentage change in the EBT, it is equal to the percentage change in the EPS. Clear? So therefore, any percentage change. Clear? So therefore, any percentage change in the EBT, it is therefore equal to the percentage change in the EPS. Clear? That is basically equal to the percentage change in the EPS here. Now further. So degree of financial leverage, clear? So degree of financial leverage, basically how it is to be defined as, it is defined as the ratio of percentage change in the EPS and the percentage change in the EBIT, and can be mentioned as under that is percentage change in the earning per share upon percentage change in the earnings before interest and tax, clear? Or percentage change in the earnings before interest and tax here, clear? So DFL. Delta, this is to be delta, not A, this is to be delta, that is delta EPS upon EPS upon delta EBIT upon EBIT, clear? Upon delta EBIT. Okay, so delta EPS, what is the meaning of delta EPS here? Basically, that is delta EPS, basically. Delta EPS, that is change in the earning per share, clear? Delta EPS basically means that change in the EPS, and delta EBIT, that is change in the EBIT, clear? That is change in the EBIT. So this formula can be further refined in view of the fact that is delta EPS upon EPS is equal to the delta EBT upon EBT as the tax rate and the number of shares which correlates EPS and EBT are to be constant here, clear? Are to be constant here, clear? Because the tax rate it is to be same and number of shares it is to be same here, clear? Number of shares it is to be same. So DFL, that is degree of financial leverage, that is delta EBT upon EBT upon delta EBIT upon EBIT, clear? Upon delta EBIT upon EBIT, clear? So this is the way, and on this formula, clear? On the basis of this formula, we are able to solve this example, clear? And there are some other formulas, that is, so in the simple language, how we can write it as the degree of financial leverage. From that, basically, we can write it as EBIT upon EBT, clear? What we have discussed in the starting, this is the formula, clear? This is the formula where EBIT, what is EBIT? That is earning before interest and tax, clear? That is sales minus variable cost minus not minus fixed cost. Okay, and fixed cost here, that is excluding interest, clear? So EBIT, that is sales minus variable cost, we will take plus fixed cost excluding interest, clear? Plus fixed cost including interest. And what is EBT? Earning before tax here. So we have to subtract the interest here, clear? We have to subtract the interest here. Just we can say that EBIT minus I, that is we have to calculate the subtract the I here. What we will left? EBT is equal to EBT. Just a funny thing here, not like that, but for remembering purpose you can do that, clear? So degree of financial leverage, that is delta, sorry, EBIT upon EBT, and where EBIT, that is sales minus variable cost minus fixed cost excluding interest. What is EBT? That is earning before tax. So basically what we have to do, basically we have to remove the interest here, clear? We have to remove the interest component here. So please tell fast now, all of you are able to understand the meaning of the financial leverage here. What is the meaning of the financial leverage? What is the meaning of the operating leverage here? In the next session, I will discuss 3 numericals with all of you, clear? Okay, like numerical number 2, this, it is same on that concept, clear? Whatever we have discussed. So this question basically I will give you for the practice purpose, clear? No need to go through the solution, just try to understand. If you are able to understand or try to solve this solution, then well and good. Otherwise, no need to worry, clear? I will help you to understand how to solve these questions, clear? Along with that, in the next session, we will cover the operating leverage also, clear? We will cover the operating leverage also, clear? So in the basically 2 sessions more we will take to cover this topic. and we will cover all the important numericals, whatever they have mentioned in the book, we will discuss one by one. Okay. So thanks to all of you for joining this basic discussion.